Hello everyone, welcome to Inconvenient Truths. I'm your host, Jennifer Zeng. Today we'll briefly discuss some unusual phenomena and rumors in Chinese politics, then delve into the astonishing debt levels rarely disclosed by CCP experts, and whether a 10 trillion stimulus can save the market, the truth behind Chinese resident savings, and why the artificial bull market at the end of September might have utterly destroyed the foundations of China's economy. There's a lot of ground to cover with very real, possibly unseen economic data elsewhere, so please make sure you stick around till the end. Okay, let's begin with the first topic. Lately, there have been numerous unusual events in Chinese politics, too many to detail one by one. In summary, many are scrutinizing every move with magnifying glasses to try to figure out the true state of Chinese politics, especially regarding Xi Jinping's power, including whether his control over the military is still solid. One view holds that his power remains stable, and another believes he has lost control of the military to Vice Chairman of the Central Military Commission, Zhang Youxia. There are also rumors that his closest aide, Cai Qi, might step down soon. And some say because Xi Jinping has mismanaged the economy, he's facing pushback from various factions within the party, compelling him to agree to relinquish power gradually to ensure his safety post-retirement, among other speculations. Personally, I believe it might be premature to draw conclusions. Even if Xi Jinping is willing to give up power, the CCP might not find someone acceptable to all parties to succeed him, or there might not be anyone willing to take over such a mess. Therefore, I don't want to spend too much time discussing these matters today. Instead, I want to focus on revealing some real data about China's economy. How large is China's debt? This has always been a mystery to the outside world. Earlier, the International Monetary Fund estimated that local government debt in China amounted to 92 trillion yuan. However, recently, an insider, Professor Li Jianjun, vice president of China's Central University of Finance and Economics, has made a rare public disclosure of this figure. Let's listen to what he said. Please pay attention to the English subtitles I've added.
那么截止到今年的上半年6月30号呢，我们中国这个地方政府债务的余额合法的部分有42.23万亿城投在隐形债务呢57.16万亿，这里呢没有统计那个隐形担保所以加起来已经是100万亿的规模就是99.39万亿。那么我们这个负债率的话，如果加上中央国债的话呢30万亿，我们已经这个负债率呢，相较2023年的这个 GDP 126万亿的话，已经超过了100%，已经远高于国际警戒线60%了60%。那么再从地方视角来看的话呢，从2个指标来衡量，一个是地方的负债率。
Well, did you hear that? He stated that the legal portion of local government debt is 42.23 trillion yuan. There is also 57.16 trillion yuan in implicit debt from urban investment bonds. So excluding implicit guarantees, these two items sum up to 99.39 trillion yuan, nearly 100 trillion yuan. This amount is more than 7 trillion yuan higher than the IMF's estimate. Additionally, the central government's debt is 30 trillion yuan, making the total close to 130 trillion yuan. China's GDP in 2023 was 126 trillion yuan, meaning the debt to GDP ratio has already exceeded 100%, reaching 103%. This is far higher than the international alert level of 6%. It's nearing the physical deterioration level seen in Greece before its debt crisis. The question now is, why would Li Jianjun choose such a sensitive moment to reveal these figures? One explanation is that the economic situation has become so dire that the officials are using this informal way to reveal these numbers to prepare investors. It's like when a plane is about to make an emergency landing, they tell everyone to buckle up. This could also be the relevant departments trying to shift responsibility, knowing that the problem is too severe for them to resolve. So they are leaking some information in advance. This way, the public can't blame them for not being warned. On Tuesday this week, Reuters reported that the National People's Congress of China is prepared to pass a fiscal stimulus plan worth up to 10 trillion yuan to promote economic recovery. Now, can a fiscal stimulus plan of 10 trillion yuan really boost the economy? Let's look at some real data. Compared to GDP figures, which are very easy to manipulate, the revenue and expenditure numbers released by China's Ministry of Finance are relatively more reliable. So, here, look at this. It's China's historical fiscal revenue and expenditure data. Look at the second column. In the first 3 quarters of this year, the total fiscal revenue of the Chinese government was 19.39 trillion yuan, while it was 20.54 trillion yuan in the same period last year. So this year, it decreased by 5.6%. This 5.6% drop in total revenue is the true decline rate of China's economy in the first 3 quarters of this year. In contrast, the National Bureau of Statistics claimed a GDP growth rate of 4.8% for the first 3 quarters, which looks extremely false in the face of this revenue drop. The GDP number was clearly fabricated. Another set of data supporting this revenue data is the profit data of industrial enterprises above a designated size. Here, above designated size refers to companies with annual principal business revenue reaching or exceeding 20 million yuan, or about $3 million. In the first 3 quarters of this year, profits of industrial enterprises above the designated size contracted by 3.4% year-on-year, with August and September seeing an astonishing contraction of 22.24% and 23.90%, respectively. Without profit, companies, of course, can't pay taxes. Now, let's look back at the fiscal revenue and expenditure table. Please look. While there is a significant drop in fiscal revenue, the fiscal expenditure data has not decreased. In the first 3 quarters of this year, total fiscal expenditure was 26.22 trillion yuan, roughly the same as last year. Much of the government's expenditure is rigid, such as public servants' salaries, the medical and educational expenses for the public. In such a situation, the fiscal deficit naturally grows rapidly. The total fiscal deficit in the first 3 quarters of this year was 6.83 trillion yuan, a sharp increase of 16.1% compared to the same period last year. Look at another indicator, the 6th column in this table, the deficit rate, which is obtained by dividing the fiscal deficit by total revenue. In the first 3 quarters of this year, China's fiscal revenue expenditure gap rate reached 35.2%, which is also the highest on record. And the current trend, this year's total fiscal deficit might exceed 10 trillion yuan, with the deficit rate exceeding 37%. So issuing 10 trillion yuan in bonds would just cover this fiscal gap. What would be left for economic stimulation? Look at this table again. In 2013, China's total fiscal deficit was 924 billion yuan. By this year, just over a decade, it has increased to 10 trillion yuan, with a compound growth rate of 53%. Isn't that terrifying? With such a scale of fiscal deficit, the only solution is to issue debt to fill it. Therefore, in the first 3 quarters of this year, 9.7 trillion yuan in national debt and 6.69 trillion yuan in local government bonds were issued, totaling 16.39 trillion yuan. This is a year-on-year increase of 12.7% compared to last year. Looking at the trend, the total bond issuance for this year will reach 23 trillion yuan. 23 trillion yuan. This number is 13 trillion yuan more than expected fiscal deficit of 10 trillion yuan for the whole year. So this additional 13 trillion yuan are used to repay maturing old debts, which is what they call issuing new debt to repay old. From another perspective, even if they've already invested 10 trillion yuan to stimulate the economy this year, how is the economy doing now? There's been no improvement at all. To really stimulate, would they need to double this figure? A 20 trillion yuan economic stimulus plus 13 trillion yuan to repay old debts, wouldn't they need to issue 33 trillion yuan in a year? What does 33 trillion yuan mean? It's an average of 2.75 trillion yuan per month. And if we calculate based on 21 working days per month, that's 130 billion yuan per day. Is that possible? As we've discussed, China's total debt now stands at around 130 trillion yuan, already exceeding GDP. On top of 130 trillion yuan, an increase of 33 trillion yuan is in just 1 year. That's a 25% increase. Is that achievable? Everyone knows no matter how much the government invests, if the public doesn't have purchasing power, the economy can't get better. Some economists have marveled at the scale of savings among Chinese citizens, saying how rich the Chinese public is. Many Chinese economists have repeatedly emphasized the need to find ways to encourage people to take their money out of the bank and consume it. So, how rich are Chinese citizens really? Let's take a good look at this table, which has all the secrets of Chinese people's wealth in it. This is the assets table for customers and or above the golden sunflower level released by China Merchants Bank. The so-called golden sunflower customer refers to clients with an average daily total assets of 500,000 yuan or more. Let's just call them big customers here. Take a look at the evolution of wealth in this table. The first column shows the year from 2007 to 2023. The second to the fifth column show the number of retail customers, the number of big customers, and their total assets amount. The last two columns show the percentage of big customers among all retail customers and their assets share. Look at the yellow column. You can see the number of big clients have varied between 0.9% and 2.5%, meaning less than 2.5% are considered big customers. Now, look at the blue column. The asset share of big clients has risen from 55% in 2007 to 81.2% in 2023. What does this mean? It shows that wealth in China is increasingly concentrated in the hands of a few, and by 2023, just 2.4% of the people holds 81.2% of bank deposits. China Merchant Bank is one of the top 6 banks in China. So if we estimate from this ratio, then out of the total 147.6 trillion yuan in Chinese household savings as of August this year, only about 20%, which is a very modest 29.5 trillion yuan, belongs to the general public. You need to understand that China's total personal debt now stands at 81.6 trillion yuan. It's conceivable that the 2% of the population with 80% of the bank deposits certainly have no debt. So all this 81.6 trillion yuan in debt is borne by the general public. In other words, for 98% of the Chinese population, their total savings are only 29.5 trillion yuan, while their total debt amounts to a staggering 81.6 trillion yuan. In such a situation, how much purchasing power do you expect them to have? As everyone knows, the Chinese government recently engineered a forced bull market through its policies. Now, here, look at this chart of the Shanghai Composite Index. This is the chart of the China Securities Index. From the lowest point on September 18th, there was a mad continuous rise for 9 days, with the China Securities Index surging by 44%. However, after the National Day holiday on October 8th, when trading resumed, it started to fall, dropping over 4 consecutive trading days, and it never regained upward momentum after that. The crazy bull market ended in just 9 days. During these 9 days, statistics show that up to 3 trillion yuan in retail investor funds entered the market, while the main force capital was in a net outflow state. This 3 trillion yuan in the subsequent decline could at best see 1 trillion yuan escape, meaning the net loss for retail investors was 2 trillion yuan. Is this 2 trillion yuan loss considered large or small? If we look at the total household savings of 147.6 trillion yuan, 2 trillion is just less than 1.4% of that, which might seem like a small loss. But as discussed earlier, for 98% of the Chinese population, their total assets are only 29.5 trillion yuan, while their total debt is 81.6 trillion yuan, meaning their net debt has reached 52.1 trillion yuan. In this context, losing 2 trillion yuan in the stock market in just 9 days. What does that mean for them? What does it mean for their purchasing power and the economic prospects of China? So, the government's rescue of the market was merely an opportunity for the market leaders, namely state-owned enterprises and big investors, to loot the already very impoverished retail investors once again. And the damage this had done to the economy is something many people have yet to realize. The original level of economic downturn will be significantly amplified. Some economists have even said that the total collapse of China's economy, which might have taken 2 or 3 years to occur, could, at the pace set by the current government actions, reach a point of no return in just 1 quarter, a point where even unlimited, unanchored money printing by the central bank would be unable to save the economy. In other words, in just 2 weeks, the CCP government has completely undermined the foundation of China's economy. Well, are you shocked? Well, that's all for today. Please like this video and subscribe for more. Please also visit my website at jenniferzengblog.com to sign up for a membership or make a donation. Your support helps me continue sharing the inconvenient truths. Thank you. Have a nice weekend and see you next time.